Let's face it, life often throws curveballs that, well, require a little extra financial help.
Definitely.
Maybe it's finally time for that reliable car,
Yeah.
Or perhaps those education costs are looming large.
Right.
Understanding the different kinds of loans out there isn't just uh, paperwork. It's really about making smart choices with your money.
Exactly.
So for this deep dive, we're breaking down the basics, the absolute essentials of loan types. We want to give you the knowledge you need to navigate this whole landscape with, hopefully, a bit more confidence.
Absolutely. It's really about empowerment, isn't it? Seeing through all the jargon and understanding the fundamental building blocks.
Yeah.
Knowing the distinctions, the real differences between loans, that can be the key to saving money and, reaching your financial goals more effectively.
Think about Sarah. We talked about her before. She was just completely overwhelmed by high-interest credit card debt.
Mm-hmm. A common situation.
Totally. And she looked at different ways to consolidate, but the difference between, say, a home equity loan and a personal loan, it was all a bit murky for her.
Yeah, it can be confusing.
It wasn't until she really grasped the core idea of secured versus unsecured debt. It's almost like understanding the difference between a handshake deal and one where you've got a guarantor,
Yeah,
right?
that's a good analogy.
That's when she could see which option would actually lower her interest and simplify her payments. That aha moment, it saved her a significant amount of cash.
And that's what we want to provide today.
Exactly. Clarity. Clarity that leads to confident financial decisions. Our mission in this deep dive is pretty simple. Give you a solid understanding of these fundamental loan types without getting totally bogged down in, all the tiny details.
Precisely. We want to distill the essential information, help you identify what really matters when you're thinking about borrowing money.
Okay, let's unpack this then. One of the most fundamental distinctions is between secured and unsecured loans. What's the essential difference we need to get our heads around?
Okay, so the core difference, it really boils down to collateral. Secured loans, they require you to pledge an asset. Could be your car, could be your house as security for the loan.
Right.
Think of it like putting down a security deposit when you rent an apartment. It lowers the landlord's risk, right? So they're maybe more likely to rent to you, might even give you a slightly lower rent.
Okay.
Same idea here. If you can't repay that secure loan, the lender has the legal right to take that specific asset you pledged.
So with a mortgage, the house itself is the collateral, the security.
Yeah.
And for a car loan, obviously, it's the car.
Exactly that. And this security for the lender, it often translates into a pretty big benefit for you, the borrower.
Which is?
Typically lower interest rates. Which makes sense, right? Less risk for them. So, for example, the average rate for 30-year fixed mortgage back in May 2025 was hovering around 6.81%.
Okay.
For a new car loan, late 2024, you were looking at an average of about 6.35%. And home equity loans, maybe a 5-year fixed one in May 2025, averaged around 8.36%.
So noticeably lower than some other types of borrowing.
Definitely. These lower rates can mean really substantial savings over the life of the loan. But, and this is the crucial thing to remember, there's that potential downside. If you default, you could lose that asset you put up.
That makes total sense. Lower risk for them, lower cost for you, but
Yeah.
with that very real risk attached. Okay, so what about unsecured loans then? How do they stack up?
Right, unsecured loans. They are the opposite in that sense. They don't require any specific asset as collateral.
No house, no car on the line directly.
Exactly. Instead, the lender is looking at your creditworthiness. Basically, your track record, your past history of managing debt, paying things back on time. That's what determines if they'll give you the credit.
Okay.
But because there's no tangible asset backing the loan, well, the lender is taking on a higher level of risk.
And I'm guessing that increased risk for the lender usually means a higher cost for the borrower.
You got it. Unsecured loans generally come with higher interest rates. For instance, that average personal loan rate, May 2025, was around 12.26%.
Oof, quite a jump for mortgages.
It is. And credit cards. Average interest rates are way up there, around 20.12%. Even federal student loans, the undergraduate ones for 2024-2025, were at 6.53%. Lower than personal loans, sure, but still technically unsecured.
Okay.
And the primary risk for you with an unsecured loan,
Yeah.
if you fail to repay, it can seriously damage your credit score. And that makes it much harder and more expensive to borrow anything in the future.
So the basic trade-off here is collateral or no collateral. And that directly impacts the interest rate and the type of risk you're taking, either losing an asset or really hurting your credit history.
Precisely. Understanding that core difference, that's the foundation. Everything else kind of builds on that.
Okay, good foundation laid. Moving on. We often hear about installment loans.
Yeah.
What exactly defines this type of loan? What makes something an installment loan?
Think of installment loans as, well, loans with a very clear roadmap for repayment. You borrow a specific amount of money and you agree upfront to pay it back over a set period, usually through regular fixed monthly payments.
Ah, so that predictability of the payments, that's a key feature then.
Absolutely. That's one of the main appeals. You know exactly how much you owe each month, and you know exactly when that loan will be completely paid off. There's a definite end date.
Right.
And installment loans, they can be either secured, like a car loan, or unsecured, like many personal loans. They're super common for financing bigger purchases. Plus, because you're making those consistent on-time payments, they can actually help you build a positive credit history.
That's a good point.
And they often come with fixed interest rates, which just adds to that predictability factor.
Okay, can you give us a sort of real-world example just to see how that predictable repayment works out?
Sure. Let's take John. Say he took out a $20,000 car loan, got a 4% interest rate, and the term was 5 years. Because it's an installment loan, his monthly payment was fixed, locked in at $368
Every single month.
every single month for 5 years. He could budget perfectly, knowing exactly what that outgoing expense was, and he knew the exact date that loan would be gone. That clarity, that long-term visibility. That's a huge advantage for a lot of borrowers.
Yeah, I can see how that predictability really helps with budgeting. Okay, now let's zoom in a bit on personal loans specifically. We mentioned they're often unsecured, but what are some of their other key characteristics?
Right. So as we said, typically unsecured. Though, you might find secured options in some really specific situations. But generally, you're looking at fixed interest rates and fixed repayment terms.
Meaning the payment stays the same.
Exactly. Your monthly payment won't change over the entire life of the loan. That average interest rate, like we said, May 2025, was about 12.26%. But, and this is really important, that's just an average. The rate you get, that heavily depends on your individual credit score.
Makes sense. So why do people typically take out personal loans? What are the
Right.
common uses?
Well, they're pretty flexible, which is part of their appeal. One really common use is debt consolidation. That's what Sarah did, right? You take out a new personal loan, hopefully at a lower interest rate, and use it to pay off multiple other debts, often high-interest credit cards. Maria's story is another great example. She had credit card debt averaging like 20% interest.
Wow.
Yeah. Consolidated it into a personal loan at 8%, saved her $200 a month. Just like that.
Huge difference.
Big time. But beyond debt consolidation, people use them for funding home improvements, covering unexpected medical bills, maybe financing other big purchases like appliances or even a wedding.
That versatility definitely makes them a popular option. Okay, switching gears slightly, but still fundamental. Whenever we talk about loans, the terms principal and interest always come up. Can you just break those down for us? What do they actually mean?
Absolutely. It's crucial. The principal. That's simply the original amount of money you borrowed, the base amount, the sum you initially received and need to pay back before you factor in any of the costs of borrowing.
So if I take out a $10,000 loan, the principal is that 10 grand.
Exactly. That's your starting point. Now, interest. That's the cost. It's the fee you pay for the privilege of borrowing that principal amount.
The lender's profit, essentially.
Well, it covers their risk and cost of funds too, but yes, it's the cost to you.
Mm.
It's usually expressed as an annual percentage rate, the APR. And you should really think of the APR as the loan's overall price tag.
Why the APR specifically?
Because the APR often includes not just the stated interest rate, but also some other fees the lender might charge. So it gives you a more complete picture of the true cost, allows for a better comparison between different loan offers.
Okay.
And interest rates themselves, they can be fixed, meaning they stay the same for the whole loan term, or variable, meaning they can go up or down based on, wider market conditions.
Got it. Can you maybe walk us through that $10,000 loan example again, showing how principal and interest work together?
Sure. So let's say you borrow $10,000. That's the principal. The interest rate is 5% and the repayment term is 3 years. Over those 3 years, the total amount of interest you'd pay would be roughly $800. So the total amount you'd repay to the lender isn't just the $10,000 principal. It's a $10,000 plus the $800 in interest. So around $10,800 in total.
Right.
That really highlights that the cost of borrowing is more than just the initial amount you get. That interest adds up.
Yeah, that example makes the cost really clear. Okay, so
Yes.
knowing all this, before anyone jumps into taking out a loan, what are the absolute must-dos, the key things to consider?
Oh, several critical steps. Number one, absolutely crucial, Read the fine print. Always. Every single word of that loan agreement. Make sure you fully understand all the terms and conditions before you sign anything.
Don't just skim it.
Definitely not. Secondly, don't just take the first offer you get. Shop around. Compare offers from multiple lenders, banks, credit unions, online lenders.
And what should you focus on when comparing?
Pay really close attention to the APR. Like we just discussed, it gives you the best apples-to-apples comparison because it includes interest and fees. It's the total cost indicator.
Okay, read the fine print, compare APRs. What else?
Definitely ask about prepayment penalties. Some lenders might charge you a fee if you decide to pay the loan off early, even though paying early saves you money on interest.
Good to know.
Also, make sure you understand all the fees involved. Are there origination fees, which are often charged up front just for setting up the loan? Any annual or administrative fees? Get clarity on everything.
Right.
And probably the most important takeaway here, calculate the total cost before you commit. That's the principal, plus all the interest you'll pay over the term, plus all the fees. Know that final number.
Those are really solid, actionable steps. Okay, we touched on credit score and debt-to-income ratio earlier. Why are these two numbers so important when you're looking for a loan?
They're hugely important. Your credit score, it's basically a 3-digit number, usually somewhere between 300 and 850, that gives lenders a snapshot of your creditworthiness.
How reliable you are with debt.
Exactly. A higher score tells lenders you've got a good track record of managing debt responsibly. Generally, scores 720 and up are seen as excellent. 690 to 719 is considered good.
And having a good score helps how?
Well, having a good or excellent score usually unlocks the door to better loan terms. Most importantly, lower interest rates. You become a less risky prospect for the lender.
Okay, that's the credit score. What about debt-to-income ratio, or DTI? How does that fit in?
Your DTI, that's calculated when taking all your monthly debt payments, mortgage, car loans, student loans, credit card minimums, and dividing that total by your gross monthly income, so your income before taxes.
And lenders use this for?
They use it to gauge your ability to actually handle more debt. Can you comfortably afford another monthly payment? Generally, a DTI below 43% is often seen as acceptable, but honestly, the lower your DTI, the better.
Shows you have more breathing room financially.
Precisely. It signals a healthier financial situation and definitely increases your chances of getting approved for a loan and getting it on good terms. So understanding both your credit score and your DTI before you even apply, it gives you a much clearer idea of what loan options might actually be available to you and what kind of interest rates you might realistically expect.
It's like knowing your stats before you go into the game.
Exactly. It sets expectations.
Okay, great. Now, let's tackle some common misunderstandings, some myths people have about loans. What are some you hear often?
Oh yeah, there are quite a few. One big one is just the blanket idea that all loans are bad, just inherently negative.
Right, like debt is always a 4-letter word.
Exactly. But the truth is, loans can be really valuable financial tools when you use them responsibly. Think about buying a home, getting an education, even strategically consolidating debt like we talked about. They can help you achieve major goals.
Okay, so not all bad. What's another myth?
Another common one, you need perfect credit to get a loan. People get discouraged if their score isn't, 800 plus away.
Yeah.
But while a stellar score definitely gets you the best deals, many, many lenders offer options for people across a pretty wide range of credit profiles. You might pay a higher interest rate, sure, but options often exist.
Good to know. What else should we clear up?
Okay, how about this one? Longer loan terms are always better. People see that lower monthly payment and think, great, that's easier.
Yeah, seems logical at first glance.
But it's crucial to realize that stretching out the loan means you end up paying way more interest over the total life of that loan, significantly more often.
So lower payment now, but much higher total cost later.
Precisely. Another myth, especially around home buying, you absolutely need a 20% down payment. That figure gets thrown around a lot.
Yeah, it feels like a hard rule sometimes.
But in reality, there are numerous loan programs out there today that allow for much lower down payments, sometimes as low as 3%, and in certain cases like VA loans or USDA loans for eligible borrowers, even 0%.
Wow, okay, so 20% isn't always the magic number. Any others?
One last one, the idea that debt consolidation is always bad or that it will definitely hurt your credit score.
We heard how it helped Maria.
Exactly. When you do it strategically, maybe getting a lower overall interest rate and making your payments more manageable, it can actually be a really positive step for your finances. And if you manage the new loan responsibly, it can even help your credit score in the long run.
So it's all about how you use these tools. Great myth busting. Okay, let's shift into some questions that listeners might have rattling around. First one, how do you actually choose between a secured and an unsecured loan? What's the thought process?
Yeah, that's a really fundamental choice. And honestly, it boils down to your specific situation and what your priorities are. First, look at your credit score. If it's maybe not the best, you might find it easier to get approved for a secured loan because there's collateral involved.
Less risk for the lender again.
Right. Then think about how much you need to borrow. Secured loans often let you borrow larger amounts. And then you have to be honest about your risk tolerance. Are you truly comfortable putting an asset, your car, your house, on the line?
That's the big one.
It is. So secured loans, usually lower rates, potentially higher borrowing limits, but you risk losing the asset if you default. Unsecured loans, no direct asset risk, but generally higher interest rates, and you'll likely need a stronger credit profile to qualify.
Makes sense.
Yeah.
Okay, another common question.
Mm-hmm.
What's actually considered a good interest rate for a personal loan these days?
Well, like we mentioned, that average in May 2025 was around 12.26%. But good is really relative, It depends entirely on your credit profile.
Right.
If you have an excellent credit score, maybe you could qualify for rates starting under 7%. So generally, if you're offered a rate that's below the average for people with a similar credit score to yours, you could consider that pretty favorable.
It's personal to your situation.
Absolutely.
Okay, next question. Can I usually pay off my loan early? Is that allowed?
Great question. In most cases, yes. Many loan agreements these days do allow you to make extra payments or even pay off the whole balance early without any penalty.
But not always.
Not always. It's really important to check your specific loan documents for something called a prepayment penalty. They're less common than they used to be, especially for personal loans, but they still exist sometimes, if there's no penalty. Then paying it off early is a fantastic way to save a lot of money on future interest payments.
Good to check that fine print again. Okay, what about fees? What are some typical fees people might run into when getting a loan?
Fees can definitely vary depending on the loan type. Origination fees are pretty common, especially with mortgages and personal loans. That's basically an upfront charge for processing the loan application and setting it all up.
Okay.
For secured loans like mortgages, you might also see appraisal fees paying someone to assess the value of the property. And almost universally, you'll find late payment fees if you miss a payment due date.
Those can add up quickly.
They can. So it's absolutely crucial to factor all these potential fees into your calculation when you're figuring out the true total cost of the loan.
Right. Another angle on cost.
Yeah.
How does the length of the loan term, how many years you take to repay, affect the total amount you end up paying back?
This is a really critical point, connects back to that myth about longer terms being better. Choosing a longer loan term will give you lower monthly payments, and that can feel more manageable in your day-to-day budget.
Seems appealing.
It does, and it's a big boot, but you will absolutely end up paying significantly more in total interest over the full duration of that longer loan.
Can you illustrate that quickly, maybe with that $10 example?
Sure, that $10,000 loan at 5%. If you take a 3-year term, your monthly payment is higher, maybe around $299, but your total interest paid is about $800. Now, stretch that same loan over 5 years, your monthly payment drops to around $189. Seems better, right?
Low payment, yeah.
But over those 5 years, your total interest paid jumps to over $1,300. So you paid $500 more in interest just for the benefit of that lower monthly payment over a longer time.
Wow, that really shows the trade-off. Okay, serious question. What happens if someone actually defaults? What are the consequences?
Yeah, defaulting is serious business, and the consequences can be pretty severe. First off, it will severely damage your credit score. We're talking major hits that can last for years.
Making future borrowing really hard.
Extremely hard and expensive if you can even get approved. It can affect renting an apartment, sometimes even getting a job. Beyond that, lenders have legal options. They can take action to recover the debt, which might mean wage garnishment or lawsuits. And of course, if it was a secured loan, you risk losing whatever asset you pledged as collateral. Your car gets repossessed, or foreclosure proceedings start on your house.
Okay, definitely something to avoid at all costs.
Yeah.
Lastly, for this Q&A bit, where can listeners find reliable, trustworthy information about different lenders? It can feel like a jungle out there.
It really can, but there are some excellent resources. The website for the Consumer Financial Protection Bureau, the CFPB, is fantastic. Lots of unbiased, clear educational material.
I go CFPB.
Reputable financial news websites, the big names, often have great guides and comparisons of loan products. And then there are loan comparison websites like LendingTree or Credible. They can be useful for seeing offers from multiple lenders side by side, but always read their terms too.
Good resources. Thanks. That Q&A was incredibly helpful. Now, bringing back to practical steps, for our listeners who are thinking, okay, I might need a loan soon, what are the concrete things they should actually do?
All right, action plan time. First step, check your credit score. And don't just get the score, get your full credit reports from all three bureaus, Equifax, Experian, TransUnion. Review them carefully for any errors. You want that info to be accurate before you apply.
Clean up anything wrong first.
Exactly. Second, calculate your debt-to-income ratio, your DTI. Get a clear picture of what you can realistically afford each month before you start looking at loan payments.
Know your limits.
Absolutely. Third, and we've hit this hard, but it's vital, shop around. Get quotes from multiple lenders, banks, credit unions, online guys. Compare the rates, yes, but focus hard on that APR because it includes the fees.
Compare the total cost.
Right. Fourth, before you sign anything, read all the terms and conditions meticulously. Understand everything. If you don't understand something, ask.
Don't be afraid to ask.
Never. And finally, fifth, make sure you have a realistic repayment plan. Don't just hope you can afford it, know how it fits into your budget. Only borrow what you are confident you can comfortably pay back on schedule.
Check credit, calculate DTI, shop APRs, read everything, plan repayment.
Got it. And are there any specific tools or resources that can help with this process?
Yeah, definitely. There are tons of great online loan calculators out there. Websites like Bankrate, NerdWallet, they have calculators that help you estimate monthly payments, total interest costs, things like that. Really useful for playing with numbers.
Helps visualize the impact. Exactly. Those comparison websites we mentioned, LendingTree, Credible, they can streamline the process of getting multiple quotes. Just be aware of how they work. And again, the CFPB website is just a goldmine of educational resources on borrowing, rights, everything.
And if someone feels really lost,
Don't hesitate to seek professional help. A qualified, fee-only financial advisor can offer personalized guidance. Or a nonprofit credit counseling agency can be incredibly helpful, especially if you're struggling with debt already. There are good resources out there.
fantastic. Okay, so to kind of wrap this all up, the big message here, the core takeaway, seems to be that really understanding these different loan types, what they mean, the pros, the cons, it's absolutely essential for making smart, responsible financial choices.
Couldn't agree more.
Always borrow thoughtfully. Pay super close attention to that total cost, not just the monthly payment. And make sure any loan you take actually aligns with your bigger financial picture, your long-term goals.
Exactly. It's about being an informed, empowered borrower, not just passively accepting whatever is offered first, taking control.
Well said. And here's maybe a final thought for you, our listener, to mull over. Take a quiet moment, maybe later today, and reflect honestly on your own borrowing habits. Do you really understand the terms, the true cost of any loans you currently have, or any you might be considering? That little bit of self-assessment can be incredibly revealing.
Absolutely. That knowledge really is the most valuable asset you have when it comes to managing your money effectively.
Great point. Now, for our next deep dive, we're going to build on this foundation. We'll be tackling managing your loans, strategies for successful repayment. So definitely tune in for that. It's the crucial next step.
Looking forward to it.
If you found this deep dive useful today, please think about sharing it with a friend, a family member, anyone you think might benefit. And of course, subscribe to the deep dive wherever you get your audio, and follow us on social media for more financial tips and insights. Thanks so much for joining us.
Keep building that financial future, one informed decision at a time.